Hey, good morning, everyone. Marty Missouri here. It's Saturday, the 5th of November, 2022, with your weekly economic update. Going to do the usual, talk for a moment about our score of our index, go through a handful of select data points. There's 45 in total. I always grab a half a dozen or so to share with you. And I'll talk a little bit about the market. We won't do a stock market technical analysis again today. We did one yesterday morning. Fascinating move yesterday across asset markets, and I'll talk about that when we get to the commodities chart. In front of you is the simple graph of our index. Actually got a nice little pop higher by about 4 points, so we're now sitting at a minus 4.4, which is still an indication of recessionary conditions, or the way I like to say it is going forward, odds of recession exceed the odds of continued expansion. So that's where we are currently, but you can see kind of an improving trend here of late. And remember, our thesis right now says the recession, so far as we see it right now to come, if indeed there is one, will be of the mild variety. And of course, that's an opinion that's always subject to change as the data roll in. So first up, auto sales actually saw a pretty nice jump here month over month. And I'm going to read from economist Peter Bookvar's assessment. Auto sales in October totaled 14.9 million, which was above the estimate of 14.5, up from 13.5, and that's what you see here. October's surge was sparked by greater availability, moderation to price increases, and delayed shipments from Q3. Boding well for the rest of the fourth quarter is that inventory will continue rising through November, which, if coupled with restraint on pricing, creates an upside to deliveries. Challenges to the rest of the year include potentially tougher economic-related headwinds, and we'll get into those obviously today and in the weeks to come, as well as less impact from the temporary lifts that helped October. And recall that an important aspect of our mild recession theory has to do with a relatively financially healthy U.S. consumer as we sit here today. Mortgage purchase applications continue to tank. Average 30-year mortgage rate dropped a little bit from 7.16 to a still very modern history high of 7.06%. Jobs number came out yesterday, 261,000 new jobs, was much better than the estimate. Unemployment ticked up 20 basis points. Average hourly earnings dropped a bit. From the job openings and labor turnover report, which came out earlier in the week, 2.7% is the quits rate, so still stays relatively elevated. The idea there is when people quit jobs, the economy is in pretty okay shape because they generally don't just quit without something better in the offing. Job openings actually picked up by like 700,000 or so. This is a month lag, as is this. So this is the September number. It says good things about the economy, but it also says tight labor market, so that's inflationary. The labor force participation rate dropped a little bit, and the U6 unemployment, which includes discouraged and part-time workers, just 10 basis points to 6.80. Under the surface, interesting when you look at, say, the household survey as opposed to the establishment survey. So I'm going to, once again, leverage Peter Bookvar and just read off of his assessment of the jobs data. In contrast to the October BLS establishment survey, the household survey saw a job loss of 328,000. And when combined with a 22,000 person drop in the labor force, the unemployment rate jumped by 0.2 to 3.7 after falling 0.2 in September. The all-in U6 rate, this one I just talked about, rose 0.1 to 6.8%. And that's interesting, the contrast between the establishment survey and the household survey. Household survey actually screams recession, right? And the establishment survey actually holds up pretty well. The stock market rallied super hard, the U.S. market, in the morning. And I'm sure the impression was that it had a lot to do with maybe the household survey coming down and thinking that the Fed is going to see that and ease off the pedal of monetary tightening and slightly rising unemployment rate and so on. But as the day wore on and U.S. stocks actually dipped into the red a bit, our foreign stock exposure, our commodities exposures remained very, very elevated. Our core portfolio was well up over 1% all day, even when the US market was down. So that was saying to us that action was probably more about, frankly, the China news this week than it was about the jobs number. And the dollar just absolutely tanked, which speaks to rallies and things like commodities and foreign stocks. Although bond yields held up all day, but I guess that makes some sense, right? If China were to unlock, this COVID zero that they're doing to their economy, well, then that could prove to be very inflationary, but also very bullish for many asset prices across the world. A little bit more about that, as I said earlier, when we get to commodities. The ISM Purchasing Managers Indices continue to roll over. The manufacturing sits at 50.2, which is basically on the dividing line between expansion and contraction. The services are still holding up, but I'm seeing the growth rate decline as well. So again, this denotes slowing of the growth rate of the economy, right, which speaks to recessionary risks rising. Heavy truck sales, however, actually ticked back up. And again, heavy truck sales have actually been good recession indicators, as you can see, heading into the last 3 or so. And you can see the trend continues to rise. So that's a net bullish look right there when we're talking the economy. So the Bloomberg Commodity Index saw this nice pop. Again, dramatic jump, absolutely dramatic jump yesterday, pretty much across the entire commodity complex and foreign stocks as well. So this speaks to the inevitable in our view. Of course, the inevitable should be in everybody's view, that at some point, whether it's when they have scalable antiviral meds, which is what they're working very hard to do, they're also working on they believe a more effective vaccine, or simply just too much economic pain to endure anymore, China will ultimately abandon slowly over time the zero COVID policy. I don't suspect that it'll be just the latter, because I believe that what's happening here is they see the potential, if they were just to open up, of just really pushing beyond the capacity of their country's medical system. So they're trying to be very careful with this. Now, we've several hints lately. Some documents have been captured and distributed throughout the internet and on some social media sites that look pretty official. And essentially what it's saying is that China has formed a committee to explore how to move away from the zero COVID restrictions and policies and lockdowns by March of next year. You can get a feel for how important this is for global assets just by the moves of this last week in certain places, Friday in particular. Now, it'll be interesting to see what Monday looks like, quite frankly, because there was a press conference in China overnight where the authorities pretty emphatically said, "You got this wrong. We are committed to zero COVID." So that press conference was designed to walk back this rumor that they're ready to exit zero COVID. Now, I don't believe that this says the rumor isn't true. What the rumor and the documents say is that there's a committee that's been formed to explore how to do this by March. It doesn't mean it's going to happen by March. It doesn't mean they're committed to making it happen by March. It says they have a committee. And they clearly weren't ready to announce this publicly. So of course they walked it back. But they did walk it back, or they tried to walk it back at certain comments from officials last week. And another document was released Thursday night, which essentially explains, I think, the huge rally that we got on Friday. And by the way, US stocks ultimately closed quite a bit higher. But I'll say it again, though. Seems like there's a concerted effort to tamp down on the expectations by the Chinese authorities. So it could be a pretty ugly open on Monday across the board, just based on that. Of course, there's quite a bit left in the weekend. I don't suspect that the Chinese authorities are disappointed by the nice rebound this last week in Chinese stocks. I don't suspect that at all. But regardless, They are not ready to make public any of their efforts to get out of the zero COVID thing. And one last point, though, in the translation of that document that I was able to pick up, and other people did as well, is that they did say that they are asking the local authorities in various jurisdictions to ease up on the extreme COVID lockdown measures. So we'll see. That there was a kernel there that said, hey, they're thinking about this. Plus, I've read in the news headlines that there's going to be a marathon here within the next week, I believe it is, in Beijing, that's been delayed for 2 years. Looks like that's on as of yesterday. And if you look at yesterday's headlines across China, these are official headlines. Things are beginning to start. Comments are beginning made about allowing international travel. And so there is some confusion, some contradiction there. But that official statement, could have traders going in the other direction. So on a short-term basis, a lot of volatility, a lot of risk there. Again, though, keep in mind, folks, I am talking about the inevitable. Ultimately, and I think it'll come when they're confident they have scalable antivirals, so that if somebody gets COVID symptoms, they can take Paxlovid, let's say, and just not end up in the hospital. That seems to be a very effective antiviral medication that they're manufacturing, as I understand it, in China as we speak. I also dialed up the Baltic Dry Index as cost of shipping goods across the ocean. So you see that's been rolling over, and that's for the fourth straight week here. So yeah, again, so that's a shipping cost input. So that would be somewhat disinflationary. Also speaks typically to weakness in the global economy. Consumer staples, consumer discretionary ratio. So consumer staple stocks of companies that create or manufacturing things you got to buy if you want to stay alive, versus discretionary, things that you spend when you're feeling good about your financials, right? So that's an important ratio to look at. One of the world's all-time best investors, Stanley Druckenmiller, pays huge attention to this kind of data. I've heard him say over and over again, he gets real nervous when the defensive stocks, the staple stocks are doing really well, and the discretionary stocks aren't. Well, what this graph right here tracks is that relationship. So when it's going up, staple stocks are outperforming discretionary stocks. When it's going down, discretionary stocks are outperforming. So you see when the economy was barreling higher, you can see it was going down because people were spending a lot of money. And so discretionary stocks were going up. You can see since late 2021 how that graph looks like with some volatility, of course. You can see during recessions and heading into recessions, right, what that looks like. And then when we've had hiccups in the market, right, the European debt crisis in here, the almost bear market 2015 and 16, virtually the bear market on an intraday basis in 2018, and then COVID, and then now. So this is a pretty strong indication that our index has it right, that a recession is looming. And one thing I didn't get to, I meant to pull it up, but I didn't. I'll just tell you the global PMIs. JP Morgan does this aggregate PMI for all of the purchasing manager surveys throughout the world. And it has moved lower into contraction territory a bit. It's still like 49.0. But that basically says the global economy is contracting. So folks, I will end on that note. And thank you as always for watching and listening. Hope you have a wonderful rest of your weekend. Talk to you again soon. Bye-bye.